We all want to pay less in taxes, but not many people know how to go about it. The rich get richer because they know how to cut down expenses and maximize their income. Paying fewer taxes legally is one game the rich folks in high towers have mastered pretty well. Finding legal ways to minimize taxes is a practice almost anyone can master, no matter your income, net worth, or tax bracket. The current federal income tax bracket spans from 10% to 37%. But if you're smart about claiming deductions and credits, you can get away with paying less in taxes. If you want to stay on track with your various financial expectations, then saving money on taxes is a must. You can achieve this by documenting all of your expenses that could potentially be deducted from your income. Experts have suggested that there are more opportunities for tax reductions for self-employed individuals and business owners. Nevertheless, salary earners could reduce their tax obligation in some ways too. You need to understand that results are not cast on stone. What works for Peter may not exactly work for Paul. Also, you may not need all the strategies to achieve your financial targets, but a careful application of some of these suggestions could be of great help to you. At this point, I'd like you to do something. Pause this video right now. Hit the like button and go ahead and subscribe to this channel. That way, you won't miss out on any of our inspirational videos such as this one. If you've done that, congratulations. Now let's continue. Different ways you can pay fewer taxes legally. 1. Retirement account. The first thing you may want to do is to contribute to a retirement account. Retirement account contributions are a top tax reduction tool, and you can take advantage of them. Contributions to traditional 401k and IRA accounts can be deducted from your pre-tax income. As a result, this could reduce the amount of federal tax you need to pay. These funds grow entirely tax-free until your retirement at the age of 59 and a half. Currently, taxable income can be reduced for contributions up to $19,500 to a 401k or 403b plan. If you're 50 or older, then you could add $6,500 to the basic workplace retirement plan contribution. To get a clearer picture of how this works, let's look at this example. Let's say you earned an income of $100,000 in 2020. If you contributed $19,500 to a 401k, that will reduce your taxable income to only $80,500. Contributions to workplace 401k accounts must be made by the end of the calendar year. But contributions can be made to traditional IRAs up until the April 15th tax filing deadline. Currently, if you don't have a retirement plan at your workplace, you can get a tax break by contributing up to $6,000 to a traditional individual retirement account, IRA. If you're 50 and older, then you can contribute up to $7,000. It's best to start early with these practices so that these accounts could help secure your retirement. 2. HSA. If you have an eligible high-deductible health insurance plan, you can use a health savings account, HSA, to reduce your taxes. This is similar to the assets in a retirement account. For 2021, the maximum deductible contribution level to an HSA is $3,600 for an individual and $7,200 for a family. These funds can then grow without the requirement to pay tax on the earnings. Contributions to these accounts offer the following benefits. 1. Immediate tax deduction. 2. Funds grow without being taxed and can be withdrawn tax-free for qualified medical expenses. 3. Any balance left at the end of the year can roll over indefinitely. 3. Standard deduction. This is the basic amount that you can deduct from your total taxable income. This is quite simple to understand and apply. Anyone can do this. Let's pretend you're single or married and you earn $60,000. In 2021, if you're filing separately, you can take $12,550 and you'll be taxed as though you earned $47,450. If you're married and you're filing jointly with your partner, your standard deduction for the year will be $25,100. If you file as the head of a household, you get $18,800 in the standard deduction. Taxpayers who are at least 65 years old or blind can claim an additional standard deduction of $1,350. The additional deduction amount is doubled for anyone who's both 65 and blind. These figures slightly differ from the previous year. 4. Start a business. Having a side business offers many tax advantages. Self-employed individuals, whether full-time or part-time, are qualified for several tax deductions. This means your freelance projects or other side gigs could get you considerable tax savings. Expenses incurred in the course of daily business can be deducted from your overall income. This could cut down your total payable tax. For self-employed individuals, the following deductions can be made. 1. Health insurance premiums are available if certain requirements are met. If you pay for your health, dental, or long-term care insurance, those payments may be deductible too. 2. A business owner may deduct part of their home expenses with the home office deduction. This could be done by strictly following Internal Revenue Service (IRS) guidelines. 3. The percentage of utilities and internet used in the business may also be deducted from income. 4. Business-related vehicle mileage. 5. Shipping, advertising, and website fees. 6. Professional publications, dues, and memberships. 7. Business-related travel. 8. Office supplies. And 9. Any expenses incurred to run your business. To get it right and safe, make sure you maintain proper records. Some of these claims are disallowed because taxpayers don't keep proper documentation. So keep receipts, mileage logs, or other records. You may need to produce these documents in the event of an audit. 5. Credit for higher education. The U.S. government offers valuable tax credits to help offset the cost of higher education. The American Opportunity Tax Credit can be claimed for the first 4 years of college. It provides a maximum credit of $2,500 per student per year. This is a credit, which means that the amount is deducted from whatever tax you might owe the government. If the credit exceeds the amount of taxes you owe, up to $1,000 could be refundable to you. There's also the Lifetime Learning Credit, which is great for adults boosting their education and training. This credit is worth up to $2,000 per year and helps pay for college and educational expenses that could improve your job skills. 6. State and local tax breaks. Look for ways to reduce your tax burden in the state and local categories. The federal tax reform law eliminated miscellaneous deductions, but many states still allow them, or they may have a lower threshold for claiming them. No matter where you live, check with your local and state taxing authorities. You could see what deductions might be available for you. 7. Check if you qualify for an Earned Income Tax Credit. You could get a refund from the government even if you're not required to pay federal income taxes. For the year 2020, the Earned Income Tax Credit is a refundable tax credit of up to $6,660. The Earned Income Tax Credit, EITC, is calculated with a formula that considers income and family size. The income limits for the credit range from $15,820 for single taxpayers with no children to $56,844 for married couples filing jointly who have 3 or more children. 8. Charitable donations. It's easy to forget the non-cash contributions, but charitable contributions made with payroll deductions, checks, cash, and donations of goods and clothing are still deductible. Although these deductions are often overlooked, they add up still. All you need to do is to itemize to claim a deduction. Since the 2017 tax reform nearly doubled the standard deduction, many people chose not to itemize. But the Coronavirus Aid, Relief, and Economic Security Act, or CARES Act, allows taxpayers who don't itemize to deduct cash donations of up to $300 made before December 31, 2020. 9. Adjust your basis for capital gains tax. According to investors, when calculating the cost basis after selling a financial asset, make sure you add in all the reinvested dividends. That increases the cost basis and reduces your capital gain when you sell the investment. For instance, if you sell your house, you may end up paying capital gains tax as well. It will be so especially if your property's value has risen significantly. Single taxpayers can get exempt up to $250,000 of their home's appreciation from capital gains tax, while married couples can get a $500,000 exemption. The IRS allows the exemption to be claimed once every 2 years. You can reduce how much you owe if you've made home renovations or improvements. According to experts, any investment you make could be deducted from the capital gains. 10. Invest in municipal bonds. To buy a municipal bond implies lending money to a state or local governmental entity for a set number of interest payments over a specific period. If you make this kind of investment, once the bond gets to its maturity date, the full amount of the original investment will be repaid to you. Interest on municipal bonds is exempt from federal taxes and may also be tax exempt at the state and local level. This could be determined by the place where you're living. Investors find municipal bonds attractive because of tax-free interest payments. 11. Donate highly appreciated stock to charity. You can use stocks to make charitable gifts. This is another way to avoid capital gains tax. Stocks that had big gains can be moved directly into a donor-advised fund, experts say. Money moved into a donor-advised fund is not only exempt from capital gains tax, but can also be deducted by those who itemize. You can start donor-advised funds with as little as $5,000. Now that you've seen the various ways you can pay fewer taxes legally, you must understand the difference between tax avoidance and tax evasion. The two may look the same, but in simple terms, one is legal while the other is criminal. Tax avoidance is legal. Tax evasion is criminal. Tax avoidance helps you to pay lower tax bills by arranging your transactions so that you can reap the largest tax benefits. If properly done, this is completely legal. On the other hand, tax evasion is an attempt to reduce your tax liability by deceit or concealment. This is an offense punishable by law. The question now is, how do you know when tax avoidance efforts go beyond the legally accepted practice? The distinguishing factor lies in whether the decisions have been made with fraudulent intentions or not. When tax planning goes too far and crosses the line, it becomes illegal. This is the reason why business owners face more scrutiny than salary earners, who are on the same income level. Business owners have more options to avoid taxes, and these options could be legal or illegal. Here are some ways business owners engage in tax evasion, which could bring them into conflict with the IRS. Deliberately underreporting or omitting income, keeping two sets of books, and making false entries in books and records, claiming false or overstated deductions on a return, claiming personal expenses as business expenses, hiding or transferring assets or income. It'll be a good idea to seek help from a qualified tax planner before applying any complex tax avoidance idea. This step could save you a lot of money and also keep you safe from legal tensions. Here are some videos you could also watch. Don't invest in the stock market until you watch this video. 14 signs you're not ready to be rich. Well, folks, thanks you so much for watching, and I do hope you learned a thing or two. With that said, have a great day, and I'll see you all in the next one.